Welcome back to the deep dive. You work hard for your money, you have big goals for it, but sometimes the difference between a minor setback and a complete life-altering catastrophe,
Yeah.
it really just comes down to the foundation you've built.
Exactly. And today we are diving into those financial foundations. We're focusing on the two pillars that, really govern your financial security, smart insurance and optimized banking.
We've looked at a whole stack of sources, everything
Mhm.
from consumer reports to these really advanced financial planning guides, and we've basically distilled the mission for you.
And that mission is to eliminate what we're calling the dangerous knowledge gap.
Dangerous knowledge gap, I like that.
Because the cost of just doing nothing here is massive. It's not just the lost interest or the unnecessary fees you might be paying every month.
No.
It's the catastrophic exposure, a lawsuit, a medical emergency, a property loss, the kind of thing you don't even realize you're exposed to until it's too late.
Okay, so that's our plan. Part one, we're going to unpack how insurance actually works to transfer risk away from you.
Wow.
And then part two, how to set up your bank accounts to maximize your cash flow and, your growth. Let's jump into the safety net.
Okay, so to start, let's just ground ourselves in the core concept. Insurance fundamentally is just risk transfer.
Risk transfer.
That's it. You pay a relatively small, predictable amount, that's your premium, to transfer the risk of a massive, unpredictable cost over to a big company.
But the key here, and I think this is where people get tripped up, is what risk you transfer. It's not for everything, right? Insurance is for the truly catastrophic financial events.
Exactly. We're talking about things that would bankrupt you. $1 million lawsuit, a life-saving medical procedure.
Not the small stuff.
That distinction is so crucial. If an expense is routine, if it's predictable, like, say, your annual dental cleaning, you might find your insurance premium actually cost you more than just paying for it out of pocket. That's a bad deal.
So let's apply that to health insurance. We all know the basic terms: premiums, deductibles, co-payments, co-insurance. But if you're looking at a policy, what's the one number you absolutely have to find?
It is, without a doubt, the out-of-pocket maximum.
Okay.
That number is the ultimate cap on what you will pay in a given year. If your individual cap is, say, $7,000, you know with absolute certainty that no matter what happens, your personal financial hit for covered expenses stops right there.
That is the real protection then. It changes the risk from basically unlimited to a known number.
Yes, it's a known quantifiable liability. Now, people do run into trouble sometimes with out-of-network providers, but for the vast majority of huge health costs, that out-of-pocket max is the core value.
And if you're on a high deductible plan, that opens the door to something incredibly powerful: health savings accounts or HSAs.
Oh, the HSA is something everyone needs to understand. It has this incredible triple tax advantage. Your contributions go in tax deductible. The money grows completely tax-free. And if you use it for medical expenses, the withdrawals are also tax-free.
And here's the really sophisticated part. If you stay healthy and just let that money grow, after you turn 65, you can pull funds out for any reason. You'll just pay ordinary income tax, like a traditional IRA.
It essentially becomes a backup retirement account. It's incredibly flexible.
Okay, so moving from health to our physical assets,
Yeah.
let's talk auto liability. Our sources were screaming about the danger here.
They were. Liability coverage is usually shown in that three-number format, like 100, 300, riddle 100.
Which means 100,000 for one person's injuries, 300,000 total for everyone's injuries, and 100,000 for property damage.
And the big warning is this. Just carrying the state minimum requirement is,
Right.
well, it's penny-wise and profoundly foolish.
Because if you cause a serious accident, those medical costs can blow past $300,000 so easily.
And when your coverage runs out, their lawyers are coming after your assets, your house, your savings, your future wages. It's not worth the risk.
So you're insuring what you stand to lose,
Mm-hmm.
not just the car itself. That makes sense. Now, with home insurance, what's the biggest mistake people make?
Insuring for the wrong value. You have to insure for rebuild cost, not market value.
Explain that.
The market value of your home includes the land it's sitting on. The land doesn't burn down, so you only need enough money to rebuild the physical structure. Insuring for market value often means you're overpaying.
And when a loss happens, how they pay you is critical. Let's talk
Yeah.
actual cash value versus replacement cost.
ACV is not great for you. It pays for the item minus depreciation. So if your 10-year-old roof gets destroyed and a new one is $15,000, ACV might only give you $6,000
Wow.
because they factor in the wear and tear. But replacement cost coverage pays what it costs to buy a brand new one today. You really want to push for replacement cost.
That's a $9,000 difference in that example. That's a
Right.
huge hit.
And a quick note, the biggest coverage gap of all. Standard policies do not cover flood or earthquake damage. You need separate, specific policies for those.
All right, let's circle back to liability, but this time for the big guns. Let's talk about the surprisingly affordable shield that is umbrella insurance.
An umbrella policy is exactly what it sounds like. It's an extra layer of liability protection that sits on top of your auto and home policies.
And it kicks in when those other policies are maxed out.
Right. Coverage usually starts at $1 million. And
Yeah.
here's the amazing part. For most people, $1 million in extra coverage only costs about $150 to $300 a year.
That's it, for $1 million in protection.
That's it. If you have any significant assets or a high income, it is non-negotiable. It protects everything you've worked for.
We also have to talk about protecting your biggest asset, which is your ability to earn an income.
Yes, the risk of disability is shockingly high. The stats say a 35-year-old has about a 25% chance of being disabled for 3 months or more before they retire.
A 1 in 4 chance. That's staggering. So if you're buying disability insurance, the definitions in the contract are everything. Specifically, own occupation versus any occupation.
Any occupation is the weaker policy. It only pays out if you're so disabled you can't do any job you're reasonably qualified for.
They could argue you could still be a greeter at a store or something.
Exactly. Whereas own occupation is the gold standard. It pays if you can't do your specific job. Think of a surgeon who loses fine motor skills in their hands. They're protected under own occupation.
Okay, before we move on, 2 quick, costly mistakes to avoid.
First, not shopping around. Loyalty almost never pays in insurance. You have to get new quotes every few years.
And second, a really practical tip. Avoid filing small claims. If you file a $2,000 claim, your premiums could go up so much over the next few years that it costs you more than the payout.
Save insurance for the big stuff, the catastrophes.
Okay, so we've protected the downside. Now let's talk about maximizing the upside by optimizing the engine room of your finances, your bank accounts. We're shifting from protection to efficiency and growth.
Let's start with the basics, the checking account. This is your transactional workhorse, right? Money in, money out. It's not designed to earn interest.
And the real enemy here are the fees. Those $10 to $15 monthly maintenance fees are just a slow drain.
And there's absolutely no reason to pay them anymore. The sources are crystal clear on this. Switch to a free checking account from an online bank or a credit union. That's $180 a year right there.
The other danger is the overdraft fee. They are brutal, typically $30 to $35 per transaction.
And they can cascade. You buy a coffee, you overdraft, that's $35. Then your utility bill hits, another $35. You can be down over $100 in fees in a single day.
So for security, a key recommendation from the experts is to use credit cards for daily spending. They have much better fraud protection.
Right. And just use your debit card for getting cash from an ATM. It keeps your main account safer.
Okay, now for the biggest opportunity, especially right now. The high-yield savings revelation.
This is huge. If your savings are in a traditional bank, you're probably earning something like 0.01% APY. It's basically zero.
Contrast that with high-yield savings accounts, HYSAs, mostly from online banks. They're currently paying anywhere from 3 to 5% APY.
Let's put some real numbers to that.
Yeah.
Say you have $10,000 in an emergency fund at 4% in a HYSA versus 0.01%. Over 10 years, you're looking at about $4,800 more in interest.
Wow, just for picking the right account.
It's free money. Your emergency fund absolutely must be in a high-yield savings account, period.
Now, if you have cash, you won't need for a fixed period, you can look at certificates of deposit or CDs. Higher rates, but there's a catch.
The catch is liquidity. If you pull the money out early, you're going to pay a penalty, usually a few months of interest.
But there's a strategy to manage that, right? The CD ladder.
Right. You don't dump all your cash into one 5-year CD. Instead, you split it up. You buy a 1-year, a 2-year, a 3-year, and so on.
Why do that?
It balances two goals. You get to lock in some of those higher long-term rates, but you also have a portion of your money maturing or becoming available every single year. It gives you liquidity and flexibility.
You might also see money market accounts. They're kind of a hybrid, but they often require much higher minimum balances than HYSAs.
And just quickly, on tax advantage growth, you have your IRAs. A traditional IRA gives you a tax break now, and a Roth IRA gives you tax-free growth and withdrawals in retirement.
And we have to say it again, that HSA is the best deal in personal finance if you can get one.
Oh, absolutely. And for anyone with a side hustle or small business, you need separate business accounts. It's essential for taxes and for legal liability protection.
That's where you'll need an EIN, an employer identification number, which is like a social security number for your business.
And a simple tool for estate planning. Put a payable on death or POD designation on your accounts. It lets the funds go directly to your beneficiary and bypasses the whole probate court process.
So when choosing a bank, don't forget about credit unions. They are not-for-profit owned by their members.
Which means they often have better rates and lower fees because they aren't trying to please shareholders.
And then you have the online-only banks. Their low overhead is what allows them to offer those incredible 4 to 5% APY savings rates.
The only real trade-off there is that it can be tricky to deposit physical cash.
Okay, final security tip that applies to everything.
Enable two-factor authentication, or 2FA, on every single account. And if you can, use an authenticator app instead of SMS texts. It's just more secure.
Okay, let's connect all these dots. Insurance provides the stable platform, the protection, and banking provides the momentum, the growth, and efficiency.
For you, the listener, if you want to take action this week, there are 3 immediate steps.
1. Review and maximize your liability coverage. Increase your auto and home limits and get that umbrella policy if you have assets to protect.
2. Move your emergency fund to a high-yield savings account today. Stop leaving that money on the table.
And 3. Audit your accounts. Make sure you are paying $0 in monthly banking fees.
The difference between the wrong accounts and the right ones can be tens of thousands of dollars over your lifetime. This knowledge is your foundation. You have to build it wisely.
Your insurance premiums are an investment in stability, and your banking choices are an investment in growth. So if your savings account is earning just 0.01%, what's the first step you'll take this week to reclaim that lost interest? Because until you make that change, you're essentially letting your bank use your money for free. Think about that.